Exchange-traded funds, known as ETFs, and individual stocks are two popular investment options, each offering distinct advantages for investors. Understanding how ETFs stack up against individual stocks can help you make informed decisions that align with your investment goals, risk tolerance, and portfolio strategy. The most important thing to understand about exchange-traded funds, or ETFs, is that they typically include a variety of equities, such as stocks, bonds, or other securities, depending on the ETF, and there are many to choose from. This type of ETF spreads out the risk and helps shield you from significant losses if a single component in the ETF investment underperforms. But there's more to ETFs than inherent diversification. They generally have lower costs when compared to comparable mutual funds, though there may be some brokerage fees. However, you'll even find some ETFs offering commission-free options. And just like individual stocks, ETFs are traded on stock exchanges, giving you the flexibility to buy and sell shares throughout the trading day at market prices. This means you can easily transform your assets into cash, providing fast liquidity. Transparency is another hallmark of ETFs. They regularly disclose their holdings, so you can see exactly where your money is going. When it comes to taxes, ETFs often have an edge, as they usually distribute lower capital gains than comparable mutual funds, making them more tax efficient. Finally, while many ETFs passively track a specific index, there are also actively managed ETFs that aim to outperform the market and have a track record of doing so. On the other hand, there are of course individual stocks. When you buy shares of an individual stock, you're acquiring a direct ownership stake in a specific company. This could come with voting rights and dividends, depending on the stock, which can be a desired benefit for some investors. The biggest upside to individual stocks is that they can offer higher potential returns than an ETF if you choose stocks that perform exceptionally well. But remember, with greater potential comes greater risk. Also, with individual stocks, you have full control over your stock selections, allowing you to tailor your investment portfolio based on your analysis, preferences, and risk tolerance. However, it should be noted that this can also lead to significant volatility and potential losses. Another key point to remember when buying individual stocks is that you may incur greater brokerage fees. Plus, actively managing a portfolio of individual stocks can be time-consuming and definitely requires more research. Unlike ETFs, individual stocks don't come with built-in diversification. To achieve this, you need to build and manage a portfolio of multiple stocks across different sectors, which requires more effort and expertise. In conclusion, ETFs offer a convenient way to gain diversified exposure to a range of assets, and they are a great fit for those who prefer a more passive investment strategy with lower risk. Individual stocks, on the other hand, appeal to those looking for direct ownership in specific companies and who are willing to take on more risk for the possibility of higher returns, provided they have the time and expertise to research and select stocks. Many investors find a balanced approach, incorporating both ETFs and individual stocks into their portfolios, allows them to achieve a mix of diversification, control, and potential for higher returns. So whether you choose ETFs, individual stocks, or a mix of both, understanding their differences can help you make informed investment decisions. Thanks for watching, everyone. For related resources, check out the clickable links in the description below. Stay tuned for more, and see you in the next one.